Government employment report showing a gain of 216,000 new jobs last month. Futures were lower off that, yields higher, but actually that has unwound a little bit. You've seen the little bounce in the futures, and yields are off their highs as maybe the number is not quite as hot as the headline makes it seem. Joining us to talk markets is Brenda Vingiello, Chief Investment Officer at Hill Global Advisors and a CNBC contributor. Brenda, good morning. So we came into this year, the market seemed pretty confident of a pretty idyllic soft landing scenario. How does this data feed into it, and what do you make of the market's rocky start to 2024?
Well, I do think, if we look at what this data and what it means, I think this continues to support a strong consumer, which in our view is really key to the economy maintaining its health as we move through the year. But I do think if we look at what happened during the fourth quarter of last year, it really was a stunning move across the board, both in equities and in yields. And I think we're just digesting here as we move into the new year. But I still think that the fundamentals should be relatively healthy if we look at earnings growth for this year. If we continue to have a strong economy, we have inflation that's easing. We also have an environment, I think, coming into this year where if you were a corporate CEO managing your business over the last couple of years, thinking there might be a recession just 6 months down the road, you're going to think about the world differently than if you suddenly think, well, actually, hey, maybe this may not be coming to fruition. We may actually have a decent economy here, and you potentially think about spending in a different way.
Yeah, and for context, this little 2-3% decline has brought the S&P back to where it was 3 weeks ago, right as the Fed gave its decision in December. So it hasn't retraced that much of the rally. Where within the market looks interesting to you, whether it be the big tech stocks that led last year or something else?
We think that more of the small and mid-cap area within the U.S. continues to look attractive. Those large cap tech names, still important to have some exposure, but we wouldn't be overexposed here. They absolutely participated in the rally during the fourth quarter, even though they had a tremendous first half of last year, and valuations not looking as attractive. Also, those are more multinational companies where I think we are going to hear more probably about more weakness in China. Those areas are more exposed versus small mid-cap stocks that are more domestically focused should benefit from strength here in the United States. And valuation is more attractive, even after the run that they had during the fourth quarter.
Yeah, certainly more room to catch up on a multi-year basis.